What's up, everyone? Today, let's dive into how we got to this point in our economic landscape. It's fascinating, really, to look back at the past 15 years. It's like holding up a mirror to our financial system. See, when we rewind back to the chaos of the global financial crisis, the world was grappling with a massive liquidity crunch. For a good 6 months, we saw it all. Stocks, gold, you name it, plummeting in value. It felt like everything was spiraling. Then came the Federal Reserve to the rescue, and they made two pivotal moves that changed everything. First, they slashed interest rates, making it cheaper to borrow money and giving the economy a much-needed boost. Second, they launched a massive bailout program, essentially printing trillions of dollars and injecting it into the system to stimulate growth. Now, these two actions, cutting rates and printing money, were crucial in averting a complete financial meltdown back then. But here's the thing. It also handed the central bank a playbook, a go-to strategy for whenever the market throws a tantrum or the economy starts to sputter. And boy, have they used it ever since. This playbook, this quantitative easing, has become the invisible hand guiding our financial lives. Think about it. After the 2008 crisis, we enjoyed years of a booming stock market, with asset prices soaring. It felt like prosperity was here to stay, fueled by cheap money and a sense of optimism. But this artificial environment couldn't last forever. Fast forward to the late 2010s, the Fed, feeling a little too confident perhaps, decided it was time to raise interest rates. And guess what? The market threw a fit. As borrowing became more expensive, asset prices started to tumble. Thankfully, the Fed realized their mistake and quickly reversed course, slashing rates back down again. And just like magic, the markets rebounded. But then came 2020, and the world was blindsided by the COVID-19 pandemic. Lockdowns, uncertainty, and another liquidity crisis. It felt eerily familiar. And right on cue, the Fed pulled out their trusty playbook. They enacted emergency rate cuts and unleashed trillions of dollars into the economy. This time, it wasn't just the Fed. Politicians joined the party too, with massive spending programs aimed at propping up businesses and individuals. And just like that, asset prices went through the roof, inflation went on a tear, and we entered a period of unprecedented market exuberance. The interesting thing is, the Fed had gotten so good at their playbook that they executed it much faster and more aggressively in 2020 compared to 2008. They had learned from their past experiences and were now hypersensitive to any signs of economic weakness. By 2021, with inflation running rampant, the Fed finally realized they had to pump the brakes on the easy money party. They started raising interest rates at a record pace, trying to rein in the inflation they had helped create. But for many investors, it was too little, too late. The party was over, and the hangover was about to begin. As interest rates climbed higher, asset prices started their inevitable decline. We even saw cracks appearing in the financial system, with banks sitting on piles of assets that were suddenly worth a lot less than they had paid for them. If it weren't for some creative accounting rules, many of these institutions would have been staring down the barrel of bankruptcy. So here we are today. Inflation has cooled down a bit, but asset prices are still near all-time highs, and interest rates remain stubbornly above 5%. The economy is sending mixed signals. Unemployment is creeping up, bankruptcies are on the rise, and the Fed is gearing up for another potential round of market intervention. The good news is, the Fed has spent the last few years reloading their ammunition. With interest rates still relatively high, they have room to cut them significantly and inject even more liquidity into the system. It's like they're a firefighter with a brand new fire hose, just waiting for the alarm to go. But here's the dilemma. Asset prices are already sky high, and the economy is showing signs of weakness. What happens when the Fed steps in with another round of easy money? Will it be enough to avert a recession, or will it just inflate another asset bubble? And let's not forget the political backdrop. We're in an election year, and both candidates have very different economic visions. How will the outcome of the election impact the Fed's policies and the overall market sentiment? These are complex questions with no easy answers. But what's clear is that understanding the patterns of the past 15 years can give us valuable insights into what might lie ahead. If there's one key takeaway from all of this, it's this. In a world where central banks are addicted to printing money and governments are happy to spend beyond their means, holding on to cash is like holding on to a melting ice cube. The real question is, are you an investor or a saver? Investors understand that while markets may fluctuate in the short term, the long-term trend is in their favor. They embrace volatility as an opportunity to buy assets at a discount and ride the wave of inflation to build wealth. Savers, on the other hand, are fighting a losing battle against inflation. Every day, they hold on to their cash. It loses purchasing power, eroding their wealth silently but steadily. So what's the answer? Well, if you have a long-term horizon, the best strategy is often the simplest. Stay invested. Ride out the short-term fluctuations and keep adding to your investments over time. This is the essence of dollar-cost averaging, consistently investing a set amount of money at regular intervals, regardless of market conditions. By doing so, you're buying more shares when prices are low and fewer shares when prices are high, which helps to lower your average cost per share over time. Now, I know that timing the market is tempting, but it's a fool's errand. The reality is, nobody can predict the market's short-term movements with any degree of certainty. The best approach is to adopt a long-term perspective and trust in the power of compounding. As Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. In a world of economic uncertainty, one thing remains constant: the power of knowledge. By understanding the historical context, the forces at play, and the potential risks and rewards, you can make more informed financial decisions that align with your long-term goals. Remember, investing isn't about getting rich quick. It's about building a secure financial future, brick by brick. It's about taking control of your finances and making your money work for you, not the other way around. So, educate yourself, stay disciplined, and never stop learning. The more you know, the better equipped you'll be to navigate the complexities of the market and achieve your financial dreams. And hey, if you found this discussion helpful, make sure to subscribe to the channel and hit that notification bell so you don't miss out on future episodes. Thanks for listening, and I'll catch you in the next one.